The Bank of Canada has sucker punched borrowers this time around and completely reset expectations. What exactly is the 25 basis points increase going to mean for you and your mortgage and the future of real estate over the next 3 to 6 months? We'll wait and see, but we can talk about specifically how it impacts you today and what the immediate effects of a rate increase are. I'm Alex McFadden, the owner of Flow Mortgage Company and a mortgage and wealth expert. And today we're going to talk about the Bank of Canada's increase on June 7, 2023, what it means for you, your mortgage, the current real estate market trends, and what to expect going forward. Well, it's no surprise, and anybody who's watching this video already knows that the Bank of Canada made a decision to increase their overnight lending rate by 0.25%, which brings us from 4.5 to 4.75%. This ends 4 months of rate pauses, which ultimately means that we're back on the increase. And the market sentiment has suggested that we're probably not finished quite yet, with another potential rate increase priced in for the end of 2023. This means that we could see interest rates go up by another 0.25% before the end of the year is out, depending on what happens with the next couple of months of economic statistics. Some of the reasons that we're seeing the rates increase by 0.25% today had to do with a few key factors. Number one would be house prices. They've taken off like a rocket, and the Bank of Canada doesn't want to see that actually happen at this time right now. Number two, jobs. Employment is still incredibly high, even with hundreds, in fact, 500,000 plus people coming to the country in 2022 and 2023. Jobs are still in demand at this point right now, and employers can't hire fast enough. This is not a good sign for an overheating economy that wants to slow down. And number three, consumer spending is still incredibly high. An interesting fact is that foreclosures on real estate, which we would have expected to have gone up, is actually at record lows. So it shows that Canadians are still making their mortgage payments now more than ever. So how does this impact you? And what does it mean for your existing mortgage? Now, many people are still on adjustable rate mortgages and have been hoping to wait out to see when rates were to come down, including myself. Well, the reality is there's an increase for about $15 for every $100,000 of borrowed money on a variable rate mortgage. And the ricochet effect for many people is at this point, it might start to cause some nervousness in the marketplace. Albeit many people can still weather the storm and comfortably make these payments, I believe that there's emotional consideration where a lot of folks will now start to look into things like locking in, refinancing, or restructuring their personal situation. Now, for any of those who are on a fixed payment variable rate mortgage or a VRM, which is most of the big banks in Canada, a lot of those folks now, if they haven't already done so, will be reaching their trigger point, and they'll be called by their banks to look at A, increasing their mortgage payment, or B, locking into a fixed rate term. Now, if you are one of those people, before you go and listen to your bank, remember that you have options. You don't necessarily need to increase it to the amount that you're required to keep in your amortization schedule. In some cases, you can just increase your payment to make sure that you're covering the interest and perhaps a small portion of principal. In addition, if you lock in right now, you're probably paying significantly more on your monthly payment. So it's possible that you could look at doing lump sums, or additionally speaking, just increasing your payment to pay down the principal amount that makes you feel comfortable. Last but not least, if you're locking in from a variable rate to a fixed rate, and you're in a situation where you're thinking about buying a second property in the future, this could impact your future plans because your debt will now increase. Now, what does this mean for variable rates, and what does it mean for the future of real estate? Well, no doubt we're seeing the impact immediately in the fixed rate market, with the bond yield having jumped 20 basis points in one day. This is likely to impact fixed interest rates. We're currently in interest rates right now with most lenders offering terms between 5 to 6%, with a few anomalies over the 6% range at this time right now, which puts us back to interest rates that were comparable in the winter of 2022 and 2023. As we look forward, what can we expect with variable interest rates? Well, the Bank of Canada has indicated they're going to wait and see what happens over the coming months, but they won't be shy to increase interest rates. This can obviously cause an effect on the real estate market, slow down refinancing and restructures as we move forward. My biggest piece of advice for those folks who are in this situation is get that unbiased third-party advice from a mortgage advisor that you trust, who can look at your entire situation, and don't just take the one option that your bank is presenting, because there are often different considerations. Most importantly, look at your overall debt profile with other properties when you're considering your different rate options. At times like this, I can't really overstress the mindset of a long-term vision. When interest rates increase in these types of capacities, historically speaking, we've also seen this follow up with interest rate decreases in a relatively short amount of time. The market is suggesting at this time right now that 2024 is when we will see interest rate decreases, and most of the market indicators are pushing a 12 to 24 month timeline before we see interest rates really drastically come down. Now, how quickly rates come down will be very dependent on whether or not we see a quote-unquote soft recession or a harder recession. This doesn't necessarily mean that people will lose their homes, but we will see some people lose jobs, and we will see, just generally speaking, less consumer spending. Now, this is a great thing for the real estate market if you're a buyer, maybe not as much if you're a seller, although the economy as a whole in the real estate market has stayed very strong, and we don't anticipate any major real estate crashes to come as a result. Ultimately, again, try to stay calm, focus on your personal budget, have that long view, and look at the 1 to 2 year time range as opposed to just today, and talk to someone that you trust to help advise and educate you on your options. Hey, if you'd like to learn more about working with us, make sure to click the details in the link below. Send us a message and we're happy to have a consultation, discuss your lending options. If you enjoyed this video and it was helpful for you, make sure to hit that subscribe, that like button, and we'll see you on the next one.